Hello. In this video, we're going to talk about current and non-current classification of liabilities. Obviously, a company would be very concerned with the classification of a liability if they have a choice. They do not want it to be a current liability because typically current liabilities are going to be paid with current assets, most specifically cash. So let's take a look at what some of these issues are. If it's a non-current liability, the current liabilities are not affected, therefore their working capital is higher, which is current assets minus current liabilities. And also their current ratio will be higher, which is current assets divided by current liabilities. So the focus over here is on what can we do to not put a liability as current if possible, but you may not have that choice. So all your long-term liabilities eventually will get reclassified as current liabilities. So the next year, if it is due, I'll have to reclassify it as a current liability in this year. That's a long-term liability. Take, for example, a 20-year bond. The first 19 years, we classify them as long-term liabilities or non-current. In the 20th year, it has to get reclassified as a current liability because when I prepare my financial statements in the 20th year, they're going to become due the next year. So I have to list it as a current liability. There are some other situations which are a little more dire, and we need to see what those are. And this one specifically we're going to talk about now is callable. If the obligation, the debt is callable by the creditor, which means they reserve the right to demand payment ahead of due date. Callable means they have that right. So there are various circumstances under which this could happen. So let's take a look at this. A debt that's callable, that's due on demand by the creditor in the upcoming or the upcoming year, even if the debt is not expected to be called. So which means if I have a 20-year debt and the creditor has a right to call it in the 10th year, in the 9th year, I have to reclassify it as current liability, even if it is not going to be called for the next 11 years. So I have to, simply because the creditor has a right to call it. When the creditor has a right to demand payment, again, which means they're going to say, I need the money now because there's a violation. There's some provision of the debt agreement that I violated that now makes the debt callable. So these were not issued as callable debt. However, there were some terms and conditions that I violated, and therefore it has to become a current liability, get reclassified as a current liability. It may not be due for another 10 years. Debt that's not yet callable, but will be callable within the year if the existing violation is not corrected within the specified grace period. So we always have this, that if I make a mistake, something goes wrong. Well, let's hope it's just a mistake. I make a mistake and I violate one of the terms. I'm given a grace period. It could be 30 to 90 days, whatever it is, whatever is in the fine print. If I don't make the correction within that grace period, then again, I have to reclassify it as a current liability. So whenever you have these kind of conditions or this word callable appears, this has nothing to do with due date. So it could be a 20-year note. In the very second year, it could become callable, and I'm in trouble because this has to be classified as a current liability now. Now, you could have a liability, whether it's current or non-current, that's due next year. But if I have refinancing arrangement, then I don't have to call it a current liability. I can keep it as a non-current liability. So I must have the intention to refinance on a long-term basis, and I must have the ability to refinance. Both intention and ability are necessary. Now, how do I prove my ability? I have an existing refinancing arrangement that's already in place, or the financing is approved. I've obtained that financing before issuing my financial statements. So my year end is December 31st. At that point of time, I have to decide whether I'm going to put this as a current liability or non-current liability. Before I issued my financial statements, let's say that's Feb 15th, 6 weeks after the end of the year, if within that 6 week period I get financing, then I can go back to December 31st financial statement and I say it's not a current liability. Again, remember, the objective over here for a company in most cases is not to have this item listed as a current liability simply because it's either a red flag or it's going to make my borrowing terms unfavorable, which means I'll have to pay more in interest, and I don't want that to happen. And also, it could trigger other debt to be in violation. That is, I'm required to, let's say, for instance, maintain a certain working capital or a current ratio. By reclassifying one item as current liability, it could mess up another liability that I have. So it could be a domino effect. For all of these reasons, companies pay close attention to this. Creditors pay close attention to this, which means we here in intermediate accounting also pay close attention to this. So let's take a look at an exercise in which we will work through 3 examples of making a decision on whether the item is a current or a non-current liability. So let me switch gears and move into this Excel spreadsheet. So here we have at December 31st, 2024, the following 3 liabilities. The question asked is, should be classified as current or non-current? So let's start with the first one. I have $10 million 9% bonds that were issued for $10 million on May 31st, 2002. So this was issued 12 years ago. The bonds mature on May 31st, 2032. So we still have lots of time. But bondholders have the option of calling the bonds on May 31st, 2025. So what we're seeing over here is this is a date that's significant. Let me just highlight this over here. The date that's significant is May 31st, 2025, because that's the date they're callable. So let me write this down over here and go through this. The maturity date is way out because I'm doing this on December 31st, 2024. I'm preparing my financial statement. I'm making this decision at this point of time. So if I look at due date, I'm good. Okay. However, if I look at the date it's callable on, it is callable next year. So what happens? This has to be listed. All 10 million of this is going to be listed as current liability. Nothing is non-current for this 10 million. Okay, so that's the bad news. So the keywords over here was it's callable on May 31st, 2025. Because it's callable doesn't mean that they're going to call it, but that doesn't matter. Okay, now let's move on to the next one. $14 million, 8% note are due on May 31st, 2025. A debt covenant requires, I can go on into reading all of this, but we can stop right here. It is due on May 31st, 2025. So let me first write that down. The due date is May 31st, 2025. Okay. What's the only way in which this will not be a current liability? If I have the intention and the ability to refinance. So let's now continue reading. A debt covenant requires Newman to maintain current assets to be 175% of current liabilities. On December 31st, 2024, Newman is in violation of this covenant. They've obtained a waiver from the National Bank until June 25. All of this doesn't matter. This is a current liability. The reason it's current liability is it's due next year, and I did not read anywhere over here that they have refinancing arrangements done. If anything, they seem to be in trouble over here. So current liability. Let's look at this third case. $7 million of 11% bonds were issued for $7 million on August 1st, 1995. So this is a ways clear. The bonds will mature on July 31st, 2025. Sufficient cash is available to retire the bonds at maturity. Well, the maturity date is next year. It's in 2025. Again, I'm preparing my financial statements on December 31st, 2024. This is within the next year. All of this is current. The good news for us over here is we're saying we have sufficient cash. So while we can just feel happy about this, but it's still a current liability. So what you saw in these 3 cases, in all 3 cases, they are current liabilities. Here, because It is due on May 31st, 2025. We're going to call it it's callable, sorry, not due, callable on May 31st, 2025. That's the first case. The second one, they say the due date is next year, within the next 1 year, and we've not done any refinancing. In the third case, again, the due date is next year, and they're saying we are prepared. In this case, we have the money. Well, again, good for us. All three are current liabilities. So I hope you've understood this, the importance, the significance of the wording, because that could change your current ratio significantly. Now, in this case, your current ratio is going to go down. Working capital is also going to be lower because your current liabilities are increasing. So on to the next exercise.